Welcome back to the show. Today we're going to dig deeper into some investment strategies. Today we have Yosef. I know some of you are familiar with him.
PE ratio is one to look at too. PE ratio tells you the investor attitude towards growth. So the historical average is about 16. So if a company is below that average, it means the market is pricing in low growth,
Mm,
which might correspond to dividend growth, but you never know. And conversely, if the PE is way above 16, like Tesla's PE is like off the chart, 80 or 100 or whatever, they're pricing in high growth, right? So that's another indicator that you can look at to balance growth versus yield. Because it's all a trade-off. You know, if you had invested in Amazon in the 2000s, you would have been making, you would have compounded your money several times over without any dividend. One thing about dividends that's a disadvantage, and that's the reason Amazon and companies like that do that, is that dividends are double taxed because you're taxed as a stockholder when you receive the dividend as if it's income. But the company's also taxed on the earnings that they made. So they're double taxed. So it's actually tax inefficient, but it's also cash in your hand sooner, right? If you put money in Amazon in 2000, you'd have to wait 15 years to really see your payoff, right? So, uh, yeah, you want to balance growth stocks versus dividend stock. You don't want to just hold there are some investors that they just hold dividend stocks, but you miss out on growth that way. I would suggest a balanced portfolio with some income producing assets, and some or oriented toward future growth because dividend paying companies can't always grow as fast because they're hampered by the dividend payment. As soon as they start paying the dividend, they're kind of stuck into that. If they know if they cut it, the market's going to start selling their stock, and no CEO wants their share price to go down, right?
That's true. Talk about double tax. Does it mean it's in double tax in the US, if it's, for instance, Amazon, or it's taxed in the US and then in my country if I buy it?
No, no,
So
no.
it's
Double taxation refers to uh, Amazon's not. This doesn't happen with Amazon. This happens with companies that pay dividends. So
Mhm.
if a company pays a dividend out to the shareholder receives the dividend as income, and they have to pay taxes on their personal dividend income. But at the same time, the company has to pay taxes on the money that they paid out as dividends. So it gets taxed twice. It gets taxed at the shareholder level and at
Mhm.
the enterprise level, which is inefficient. That's why a lot of companies such as Amazon and Berkshire choose not to pay dividends at all, and they reinvest all the money back into the company with the theory that that will provide the max. We know the best way to grow the company for the shareholders that will provide the maximum value. Some companies, their return on capital isn't that high, like especially in a mature industry like, food and grocery and things like that, telecom, Verizon, AT&T. They've reached a maturity point where their return on capital is not that high, so their obligation to investors is to just return some of the capital.
If you watch this video, please leave a comment. Maybe open questions will left, and we can cover them in the next video.